For 3 years, the story in semiconductor markets has been singular and relentless. GPUs are the engine of AI. NVIDIA is the only chip that matters. Every data center dollar flows toward graphics silicon. That consensus hardened into something close to orthodoxy. Then, Intel reported first quarter earnings, and something unexpected happened. Not just a strong quarter, Intel has now beaten expectations for 6 consecutive quarters, but a single data point that reordered how the market thinks about AI infrastructure entirely. Intel CFO said that GPU to CPU ratios can actually flip in agentic workloads. That sentence sent Intel stock up 21% in a single session. It pulled ARM holdings up roughly 15% in sympathy. Advanced Micro Devices followed at 13%. The question worth sitting with is not whether Intel had a good quarter. The question is whether one line from a CFO call has identified a structural shift in how AI compute actually scales, or whether the market just found a reason to rotate into a stock that had been left behind. Revenue came in at $13.6 billion, exceeding the midpoint of guidance by $1.4 billion. That gap is notable, not because it is large in isolation, but because it marks the 6th consecutive quarter where demand outpaced what management had signaled. At some point, repeated outperformance stops being surprise and starts being a new baseline. The segment that drove the reaction was data center. Intel's data center and AI revenue reached $5.1 billion, up 22% year over year. Operating profit for the segment ran at 31% of revenue. Gross margin came in 650 basis points above guidance, attributed to higher volumes, better pricing, and improving yields on the 18A process node. 60% of Intel's total revenue is now classified as AI-related, and that bucket grew 40% year over year. ASIC revenue more than doubled year over year. Advanced packaging backlog grew during the quarter, with management describing demand reaching billions of dollars per year. None of those numbers on their own explain a 21% single-day move. What explains it is the context in which they arrived, and the mechanism Intel's management described for why CPU demand is accelerating now, not later. The standard frame for agentic AI spending assumes that more capable AI means more GPU demand, more reasoning, more inference, more compute. That logic has held for generative AI, models that respond to a prompt. But agentic AI works differently. These are systems that initiate actions, monitor outcomes, and loop through multi-step workflows without human checkpoints. What Intel CFO disclosed is that in these agentic deployments, the ratio of GPU work to CPU work can invert. The GPU handles the model inference, but the orchestration layer, managing state, routing tasks, handling tool calls, coordinating between agents, runs on CPU. As the number of agents in a system scales, the CPU coordination layer grows faster than the GPU inference layer. That is the mechanism. HSBC upgraded Intel ahead of earnings specifically on this thesis, noting that the market was overlooking the server CPU-led growth opportunity. The upgrade was not a general endorsement of Intel's turnaround. It was a specific call that agentic AI deployment patterns would surface CPU demand in ways the consensus had not priced. ARM holdings moved 15% on the same day, not because ARM makes CPUs that compete with Intel Xeon. ARM licenses architecture. NVIDIA uses ARM, cloud hyperscalers designing custom silicon use ARM. If agentic AI deployments require more CPU capacity across the board, that royalty stream grows regardless of who builds the physical chip. That is a different kind of exposure than most investors had modeled for ARM, and the market repriced it in hours. Intel's foundry ambition adds a second layer to the story. The 18A process node has entered high-volume manufacturing at around 10,000 wafer starts per week, with yields moving toward commercially viable levels. Chip-making equipment orders ramped more than 50% year over year entering 2026. The upcoming 14A node is being designed from the ground up for external customers, incorporating RibbonFET and high-NA EUV lithography, technologies that bring Intel into direct competition with TSMC at the leading edge. CEO Lip-Bu Tan announced a partnership with Elon Musk's semiconductor initiative Terafab, which spans SpaceX, xAI, and Tesla. The framing was pointed. A year ago, the conversation about Intel was about survival. The conversation now is about how fast capacity can be added to meet demand. That is the upside path. Evidence points toward it being durable, but only if 2 conditions hold. First, agentic AI deployment actually scales at the rate enterprise adoption suggests. Deloitte alone announced over 1,000 pre-built AI agents and a dedicated agentic transformation practice in the same week as Intel's earnings. If agent-based workloads become the dominant enterprise AI deployment model, the CPU demand thesis compounds over time. The downside path is real, and management acknowledged it directly. Memory, wafer, and substrate costs are rising, and those input pressures land in the second half of 2026. Intel CFO said the company is planning for PC demand to decline by low double digits for the full year. The foundry segment still carries an operating loss of $2.4 billion in a single quarter, even as that loss improves gradually. Free cash flow remains negative. The Fab 34 buyout in Ireland added $6.5 billion in new debt. The asymmetry in the near term is that server CPU pricing is strong, precisely because supply is constrained. Intel can ship more Xeon processors and charge more for them simultaneously. That combination drives the gross margin beat. But that pricing power is a function of supply tightness, not permanent competitive moat. AMD reports earnings in early May. If AMD's data center CPU numbers confirm the same demand signal, the CPU thesis gains structural credibility. If AMD guides cautiously, the Intel move starts to look more idiosyncratic. Intel, ARM Holdings, and Advanced Micro Devices each carry a different version of the agentic AI CPU thesis. Intel is the most direct expression. The Xeon server business is supply constrained and pricing well. The foundry adds a call option on external manufacturing revenue. External revenue is still only $174 million, but the backlog and the customer pipeline are building. The risk is second-half margin compression from input costs and the ongoing foundry losses. Evidence leans toward continued data center strength, but only if memory cost inflation stays manageable. ARM's move is the most interesting analytically. The market is not betting that ARM wins the agentic CPU race directly. It is betting that ARM's licensing model captures a royalty on every architecture that does win: NVIDIA custom silicon, hyperscaler custom chips, Intel's own designs for Terafab. ARM also debuted its own custom data center chip last month, which opens a direct revenue stream that is entirely new to the model. If that product gains traction, the ARM story shifts from pure licensing to something closer to a product company, a multiple expansion event, not just a revenue growth event. AMD sits between the two. It benefits from CPU supply constraints alongside Intel, and its data center GPU business gives it a second vector on AI infrastructure spending. The MI450 GPU has committed buyers in Meta and OpenAI for the second half. AMD reports May 5th. That date now carries more weight than it did a week ago. The convergence point across all three is the same: enterprise agentic AI deployment moving from pilot to production. Deloitte survey found AI tools available to workers at 60% of organizations, and that figure represents the pilot phase. The production phase, where agents run workflows without human oversight at scale, is what the semiconductor market is beginning to price. That transition is not guaranteed on any specific timeline, but the direction of enterprise AI spending suggests it is closer than the pre-earnings consensus assumed.